Hello and welcome to my June economic and RBA update. And as usual, there's plenty to talk about. The key themes I want to focus in on is global inflation challenges persist, with Russia and China continuing to spoil things for everyone. I want to talk about the new federal government. We have a new federal government at their hands at the economic wheel. The big question is, how well can they drive? RBA are at it again, increasing the cash rate once again this month, and they're not done yet. And finally, at the end of this update, I want to talk about the biggest challenges facing a particular section of the property sector for a very, very long time. So what are we waiting for? Let's get straight into it. And I wanted to start this month talking about the global oil story first. The oil price remains stubbornly high, even though there's continued evidence of a global slowdown, which would traditionally see oil prices fall. However, we aren't seeing this time around, and that's because the Western world continues to make a stance against Russia, which, for the record, usually produces around the third biggest oil producer in the world. But sanctions placed on Russia are reducing their ability to sell their oil at the volumes that they once did before they illegally invaded Ukraine. And this is resulting in the oil price remaining stubbornly high. To counter this, last week we saw OPEC, which is the Organization of the Petroleum Exporting Countries, agree to increase the size of its oil supply expansion by about 50% in July and August. They were bending to pressures to fill this gap created by sanctions on Russia's supplies. They agreed to add 648,000 barrels a day in July and August, which is up from 432,000 barrels a day recently last month. Let's take a little price history story, if we can, for context here. Through much of 2021, oil traded around $60 to $80 US a barrel. After the invasion occurred, it's trading at a range of around 100 to 120 US a barrel. In percentage terms, that's a price hike of over 50%. Now, how important is oil to the world economy? Well, outside of actual currencies being traded, oil is by far the biggest traded commodity on the planet. And oil, or petroleum, is used in so many products that we consume every day. And if it's not in the products we consume, well, it's absolutely needed in terms of the transportation of those goods around the world to get them on their shelves and ultimately in our front doors. And of course, last month in my economic update, I mentioned about oil's role in the current energy crisis. As oil is in short supply and as higher priced, it also means that alternative fuels such as natural gas and coal see their prices also spiking, which is causing overall energy price spikes across the globe. Here in Australia, last week we've been warned about a pending bill shock in the form of our household electricity bills, especially in New South Wales and Queensland, where they're predicting that the prices could go up as much as 10 to 20% this year alone. The bottom line is, if we can get oil prices lower, we take a huge amount of pressure off input, transport, and energy generation costs, which in turn takes pressure off the global inflation story. Now, this is not great news to be sharing as the first focus point of my June update, but we have been warned. And as global citizens, we need to stand firm against Russia to ensure they don't get the idea that they can invade any independent state that they want to. So it's a price, hopefully, we remain willing to pay in the short term to get Russia back in their box. Now, let's turn our attentions to the US now, starting with their inflation numbers. The US CPI data for April came in stronger than expected, although annual inflation pulled back slightly from the previous month. Headline inflation came in 0.3% higher over the month and 8.3% in annual terms, down from the 41-year high of 8.5% in March. Core inflation rose 0.6% in the month and is 6.2% over the year. Now, looking at their GDP numbers, we saw the second estimate of US GDP reveal a slight revision for quarter one, from a fall of 1.4% to a fall of 1.5% in annual terms. Inventory data was responsible for the increased decline, although personal consumption was revised up in the March quarter. On the consumer confidence data, we saw those inflationary concerns among households has led to consumer sentiment falling to its lowest levels since 2011. The preliminary estimate from the University of Michigan's Consumer Sentiment Survey dropped to 59.1 in May, following an outcome of 65.2 in April. The outcome was weaker than the 64% expected by consensus. Buying plans for durable goods declined to a record low as high prices impacted planned spending. Consumer expect prices to increase by 5.4% over the coming year. And this is the third consecutive month that inflation expectations have remained around a 4-decade high. All eyes now focus on what the Fed will do with interest rates. And it's clear that the Fed is going to pull the trigger on a 50 basis points hike this month. And also it's well predicted that they're going to pull the trigger on a 50 basis points increase again in July as they try and rein in the inflation in the US. Closing out the US data for this month, we saw positive news. We saw some positive news, and that was non-farm payroll increases of 390,000 new jobs last month and an upward revised 436,000 gain in April. The unemployment rate held at 3.6%, and the labour force participation rate, which is the share of the population that is working or looking for work, rose to 62.3%. And the rate of workers aged 25 to 54 climbed to a pandemic high, a post-pandemic high of 82.6%. So that's good news that workers are coming back into the workforce. The irony here is that any good economic data is actually hurting the US equity markets, as they're arguing that this gives the Fed more reason to increase the cash rate and interest rates. And that's ultimately going to lead to, slowing demand and lower profits, generally speaking, for those companies. And that's impacting on the share price corrections that we're seeing both in the US and around the world. Now, that's it for the US data for this month. Let's turn our attention now to China. The biggest story in China continues to be around COVID and the Chinese government lockdowns as part of its attempted elimination strategy. The strategy is resulting in exacerbating the global supply chain challenges, and this is starting to show up in the data. Here's an example. The trade surplus widened to 51.1 billion US in April from 47.4 billion in March. Exports rose 3.9% over the year to April, down from a 14.7% annual rise in March. This is the slowest annual rate of export growth since June 2020. Annual import growth also was flat in April, following a 0.1% decline in March, all because of the lockdowns. In response to the lockdowns, the government has implemented some economic stimulus measures. They announced last week 33 measures to boost economic activity. In summary, this included offering more than 140 billion yuan or 21 billion US in tax relief for businesses and consumers, such as rebates to companies, reduce car purchase levies, and extending the delay in the firm's social insurance contributions. Furthermore, state-owned banks were ordered to provide 800 billion yuan in funding for infrastructure projects. And importantly, authorities have now relaxed some of those strict virus controls as COVID numbers have been declining. Shanghai and Beijing have lifted some of those lockdown measures on residents, opened up transport and restaurants for in-restaurant dining. So we're starting to see some of that opening. Their domestic economy hasn't been immune to the lockdowns either. So we saw retail sales plunge 11.1% over the year to April, following a 3.5% annual fall in March. The result is the biggest annual fall in sales since March of 2020 when the pandemic began, and was softer than the 6.6% decline expected by economists. Industrial production also fell short of expectations too in April, falling 2.9% in annual terms compared to consensus expectations of a 0.5% rise. This was the first monthly fall in industrial production since March 2020 and is the largest fall in over 32 years. In more recent data, we saw the Manufacturing Purchasing Managers Index, the PMI, strengthen in May, lifting to 49.6 from 47.4 in April. The Services PMI also rebounded in May, jumping to 47.8 from 41.9 respectively. The result was stronger than expected by consensus and provided an indication that activity may be quick to recover as restrictions start to ease. That said, these two important indicators remain in contractory territory. So readings above 50 mean expansionary. So these are also saying that these areas of industry are still in a contractory state. And the lockdown in China is also causing plenty of inflationary damage globally. Let's focus firstly on steel shipments, or the lack of them really. This has resulted in short-term spikes in steel prices across the globe, including Australia. And hold that thought, because I want to talk about that particular stat when I talk about what's happening in the housing construction sector of the Australian property market later in this update. Finally, in terms of inflation in China, the story is a lot better than other parts of the globe. The consumer price inflation rose 2.1% over the year to April, beating consensus expectations of a 1.8% annual rise. The result follows a 1.5% annual increase in March. So it's showing up in China that it's not immune to the inflationary pressures, but right now they are not showing up in the levels that we're seeing in the US or the Eurozone, which is my segue to now talk about the Eurozone. And let me just highlight some of the related inflation of their story. It's because it's pretty grim in regards to what's happening with inflation in the Eurozone. The producer price index rose 1.2% in April, taking the index a whopping 37.2% higher over the year. This is a new record in annual inflation rate in data dating back to the early 1980s. Looking at one particular economy, Germany, the Germany producers prices rose by 2.8% in April and by 33.5% in the 12 months to April. The annual gain was the highest since, wait for it, 1949. Gas prices also shocked, spiking nearly 155% higher year on year. So you can see how these price increases are having a material impact on energy prices, and the net result in production costs is that those things are they're becoming a lot more expensive to produce goods in the Eurozone right now. In some good news for the Eurozone, we see that their unemployment rate was unchanged in April at 6.8%. The jobless rate has remained steady at a record low of 6.8 for the past 3 consecutive months. The manufacturing PMI was finalized at 54.6, up slightly from a preliminary reading of 54.4. The result is the softest reading since November of 2020, although importantly, it remains comfortably within the expansionary territory. Durable good orders advanced 0.4 in April. This result highlights sustained demand for business equipment and merchandise despite these cost pressures. Now, to help combat the inflationary story in the Eurozone, the European Central Bank, the ECB, appears certain to start raising rates in July. It's looking at a 25 basis points increase and then talk of another 25 basis point increase in September. They've got a very, very difficult balancing act there because the economy is somewhat sluggish, but they obviously have these inflationary pressures as well. So in summary, it is very challenged in the Eurozone right now. Their conditions, the war in Ukraine is obviously having a big impact in terms of how they are able to establish cost bases and manage that inflation story there. So hopefully we can see some resolution to that war in the Ukraine, and hopefully things getting back to normal when it comes to the Eurozone. Okay, that's it for the global wrap for June. Now let's focus in on the Australian market here back home. Starting with the RBA board meeting today, we saw Governor Lowe and the board lift the cash rate by 50 basis points, taking the cash rate to 0.85 of 1%. As I mentioned last month, it really doesn't materially matter how much the cash rate moved today, but rather just how far they are going to have to go to get inflation under control. And it's definitely higher than where the cash rate is today. If we believe the big four banks' forecast, we're going to finish the year with a cash rate of around 1.35 to 1.75. So just make sure in your own household budgets that you're factoring in at least another 1% increase to your current mortgage rates, if you have one, by the end of the year. If you're also considering fixing your rate, I'd probably warn against that. Fixed rates are too high now and represent very little value. So you'd be paying more than the best variable rate in the market, and by some way too, if you decide to fix. So I would be very careful in making that judgment of fixing your rate anytime soon. All right, let's talk about the other big news of the last month, and that was the federal election. The result is in, and now we do have a new team driving the economic bus in the economy. So congratulations to the Australian Labor Party for winning majority government. And thank God they got to the majority in the lower house in the end. Otherwise, it would have been a complete mess in that chamber with horse trading going on everywhere. Now, what do I mean by that? Well, some might say, it's good to have independence, good to have a varying voice heard in Parliament. That might be true in some respects. But if history is any guide, what happens in those situations is that horse trading ultimately leads to excessive spending. So new agreements, which are usually about spending more of our money, which ultimately results in higher taxes. And that ultimately means less money in your pockets. So that's a good news story that Labor has power in the lower house. They still have their work cut out in the Senate. So they are definitely inheriting a very, very strong economy with record levels of employment, record levels of business profit, which in turn is delivering record levels of tax revenues. Labor do have a pending energy crisis that's only going to get worse, especially in the short term, given we all want action on the climate and we all want higher wages to help the cost of living pressures. But with both of those comes short-term pain and greater pressure on inflation by their very nature. So it's important to understand that, that they do have some challenges. And to top it all off, they have a housing crisis looming in new builds, which I'm going to talk about more in a minute. And the rental crisis isn't enough. And when we're also sort of putting further pressure or sort of further fuel on the fire in terms of many state governments with their new tenancy reform programs are also making the problem worse when it comes to rental affordability with the cost increases going on there. So in my humble opinion, what can they do about this? They immediately need to lift immigration to let more skilled and unskilled labour in for the construction sector and ultimately across the economy. They also need to do this ASAP. Sure, I understand that this will put some pressures on rental accommodation, but if they don't, they run the risk of creating a situation of stagflation, a stagflation environment in this country. And that will be, catastrophic for jobs and also the overall economy. So it's a difficult area to navigate through, but ultimately that's what we need to see happen. There's no real alternative solution other than to bring those people in to fix those immediate problems that we have. So we aren't going to have to wait very long overall in terms of to see how good their economic management credentials are. We should have the answer inside the next 12 to 18 months, but we do wish them good luck. We congratulate Albo and Labor, and the economy and the Australian people are counting on them to get it right. So please don't stuff it up. In terms of how good the current economy is, we got the GDP read for the March quarter and the numbers show a very resilient and solid economy, even in light of the floods and weather disruptions that we endured in both Queensland and New South Wales. The economy grew by 0.8% in the March quarter. Annual growth was 3.3%, above our long-run growth pace, and the economy is 4.5% bigger than before the pandemic. It was also a strong consumer spending underpinned the overall growth story for the quarter. Consumer spending jumped 1.5% in the March quarter after a spike of 4.6% in the December quarter. And again, over the past 2 quarters in March and December, we saw 8% in the second fastest on record. So it's a very, very strong 2-quarter result when it comes to consumer spending. Spending growth was led by industries that have been at the coalface of closed borders and mobility restrictions, notably transport services, hotels, cafes and restaurants, and recreation and culture all saw excellent increases in regards to spending. Government spending also added considerably to the growth in the quarter, reflecting support for flood-affected regions and spending on pandemic responses such as rapid antigen test kits coming into the country. Importantly, also an uplift in business investment was also a key feature. Business confidence remains buoyant and businesses are expanding and taking advantage of some current government incentives. All in all, it's a very good picture. But as I noted earlier, headwinds are building. So we'll have to wait and see what other challenges the economy presents as we move from a pandemic to an endemic status with COVID and the growing inflation story. Let's talk about jobs and unemployment rate now. I mentioned it earlier. In really solid news for the economy, our latest unemployment job read was effectively great reading all round. The unemployment rate fell 0.1 percentage point to 3.9 in April, the lowest since August of 1974. In recent months, full-time jobs have grown rapidly. In the 3 months to April, the record number of full-time jobs were added. The expansion in full-time employment reflects the strengthening of the job market as some part-time workers likely move to full-time. The underemployment rate, which includes people who are employed but wish to work more hours, fell to a 6th consecutive month low in April to 6.1%. This is the lowest level of underemployment since September 2008. Job vacancies are at their highest level on record. So there is clearly plenty of jobs to be filled, but these positions cannot be filled if businesses can't find the right people. Hence the reason for stronger immigration. The participation rate fell to 66.3 off a record high of 66.4. Meanwhile, hours worked was 1.3% in the month, is a new record high as employers look to utilise more labour. The RBA is forecasting that the unemployment rate could fall as low as 3.5%, which again is great news considering the higher cost of living we are going to face over the next couple of years. Speaking of trying to combat the cost of living, let's take a look at the wages data. The wage price index rose by 0.7 over the March quarter, matching the quarterly pace set in December. In annual terms, wages grew by 2.4%, the fastest annual pace since December quarter of 2014. In 6 months annualized terms, growth hit 2.6%, the highest since March 2014. Wages growth has continued to be led by private sector in the March quarter. Private and public sector wages increased 2.4 and 2.2% respectively in annual terms. Looking at consumer confidence and sentiment now, the Westpac Melbourne Institute Consumer Sentiment Index fell for a 6th consecutive month, dropping 5.6% to 90.4 in May. The result marks the largest 1-month fall in sentiment since August 2020, when Melbourne entered its 2nd lockdown. Consumers are increasingly concerned about the rising cost of living, and the survey also captured the first interest rate hike since 2010. The combination of rising interest rates and higher inflation is unsettling consumers right now. With those with mortgages are facing a reduction in their disposable incomes as their borrowing costs rise, or they're also getting less bang for buck as their purchasing power is eroded through higher prices due to inflation. Add to this the softening property market where values are either falling or growing at a slower pace. You understand consumers are trying to absorb all this whilst trying to remain optimistic. Right now, pessimistic thoughts are winning. We've just got to remember that there are heaps of jobs out there and we're at record levels of savings as a backup. So hopefully we can start to be a little bit more optimistic as things settle, and we also have a new government. For some, that might make them a lot more optimistic. Staying with household for now, let's talk about retail sales. Retail sales rose by 0.9 in April, hitting a new record high. This is the fourth consecutive month of growth and follows strong gains of more than 1% over the first 3 months of 2022. So while some are feeling pessimistic, at least more are still out there spending to keep the economy moving forward. Spending was higher across every state and territory except for New South Wales. Western Australia and Tasmania led the growth. Spending in Queensland was also supported by further easing of restrictions. Spending by holiday makers likely also supported growth in that state. Spending was mixed across categories. Services were hit particularly hard during the pandemic, including hospitality, but spending patterns are rebalancing as restrictions ease. The biggest increase in spending in the month was on dining out. In contrast, spending on household goods edged back in the month. Business confidence and conditions, and I'm a big believer that this is obviously an important measure, so I'm keen to talk through this data. Business condition jumped 5 points in April to be +20, the highest reading since June of 2021, and more than 3 times the long-term average, which is +6. An improvement in trading and profitability measures underpin the rise in conditions. Each of these sub-indices jumped to a 10-month high, reflecting strong demand in the economy. From a confidence standpoint, it remains elevated, but fell 6 points to be +10 in April. It's the first fall in 4 months. Confidence is still above its long-term average of +4. Cost pressures continue to build in April. Quarterly growth in purchases and labour costs jumped to new record highs, suggesting inflationary pressures are likely to continue to build over the coming months. Businesses have been incredibly resilient through the start of 2022 and confidence has remained buoyant. However, staff shortages, supply chain disruptions, growing inflationary pressures are becoming to weigh on business optimism. So we need to keep an eye on those particular data points over the coming months. Private capital expenditure, another key indicator. New private capital expenditure, which is CapEx, declined by 0.3 in March quarter. This follows a revised 2.3% increase, which was previously only 1.1. So that's a material increase in the December quarter. It's important to note that supply disruptions, flooding and labour shortages impeded CapEx expenditure in the March quarter. So they're expecting that to improve. The weakness in the quarterly result was driven by a fall in spending on building and structure, which declined 1.7% in the March quarter. Conversely, spending on machinery and equipment rose 1.2% in the period. Generous tax incentives are helping to entice businesses to increase spending on machinery and equipment. Additionally, the economic recovery and increase in demand has incentivized businesses to expand their capacity, which is a very, very good sign. Spending plans were upgraded. This financial year is nearly over, and spending is set to increase nearly 15% bigger than the previous year. However, estimate 2 of the 2022-23 suggests another big lift in spending by businesses in the new financial year. Indeed, this is estimated to come to fruition. Spending could be 16.6% higher in 2022-2023, and that will be the highest annual growth in 11 years. The upgrade in spending plans is welcome news to the economy and underpins its momentum. I've talked a lot about this in the past in terms of the importance of businesses being positive about the future. We need to keep a watchful eye on this as a leading indicator of the economy and where it's heading. Let's now talk property. And there's a fair bit of property news that I want to talk through. So let's start with building approvals and this big story developing around new builds. So building approvals declined 2.4% in April. Approvals are now 36.8% below the peak from March 2021. Demand had been supercharged by low rates and government support back then and has since fallen back considerably. Private building approvals declined by 1.7% in April, driven by a 6.1% fall in multi-density approvals. Private house approvals edged up 0.5%, but have declined in 8 of the past 12 months. That said, it's important to note that they still remain elevated relative to historical numbers. That's the pressure we're seeing in terms of home building at the moment. Now, builders are facing significant supply headwinds. Labour and material shortages are a major impediment. Let me give you some ideas, and I mentioned some of this earlier. The costs of reinforced steel for building has increased in Australia by 43%. Structural timber has increased in prices by 39%. Plastic piping is up some 26%. Now, the result is that the average home is now costing over $76,000 more to build than 12 months ago. So to give you a clearer picture of where money goes when it comes to building a new home, so this is a good rule of thumb for all of you to understand in terms of material costs. So 40 to 45% of total cost to build are those material costs. Labor costs, 35 to 40%. And then the profit margin usually is around that 15 to 20%. Now that's excluding taxes and other government charges and of course the cost of the land. But that just gives you some idea in terms of the margins that builders are working on, that 15 to 20%. Now those supply chain delays have resulted in construction delays. So a typical detached home, which usually takes around 6 months to build, is currently averaging around 9 months with those delays. Now, the cost pressures and the delay pressures are squeezing the thin margins that the builders have been working in, and that is obviously creating a perfect storm right across the whole industry. Now, this leads me to my big talking point and a developing story that could lead to significant challenges for new residential builds in Australia. We potentially run the risk of seeing hundreds or possibly even thousands of new homes being built that are halted or even stopped due to major builders going under from these cost pressures. Worse still, we could see banks stopping lending as builders can't guarantee fixed building price contracts. And we understand that banks won't lend on new construction unless they have a fixed price contract. So builders want cost plus, banks don't want that. And the reason why banks don't want cost plus is really simple, that if there is continued cost blowouts, then the reality is that the owner of the property will actually run out of money or will come back to the bank for more money, which they can't borrow because interest rates are going high. So it really is a perfect storm that is forming in the new build area. So what's ultimately going to happen? Well, we will see the developing story is already taking shape. We may see that the governments might need to get involved here so we don't see this contagion effect occurring when it comes to new builds, because it is a serious risk in terms of getting those properties built. And that naturally has flow-on effects in terms of further pressure on accommodation, rental accommodation, as those delays continue to keep building out. So it really is a massive problem that's developing. Now, in addition to that, thinking, as investors, we might see a move away from new builds, given those uncertainties that I've just been talking about. And we might see a flight towards existing or established builds. And that could also mean, and the reason for that is simple, obviously the costs keep going up, it's harder to get finance for those. So if you're worried about potentially losing your deposit or worried about your builder going broke or whatever that is, a sure way to actually avoid that is to actually look at existing properties and potentially buying one of those existing properties, so you don't run the risk of basically not having your property built, or even worse still, you losing money because your builder goes broke. So that is a developing story, and it might just basically see, existing properties from a price point of view have enough demand to actually see those property prices go higher, whereas new property builds and new property prices might actually go lower in some of those new greenfield areas. So that's why it is a big developing story. We've got to be really clear. I don't want to panic people, but in the same sentence, I also want to make sure that people understand the risks that they may be getting involved if they're considering buying new build or buying a house and land package at this uncertain time. All right, looking at the data results that we saw come in for May last week, we saw dwelling prices decline by 0.1% in May. This was the first national drop in dwelling prices since September 2020. Reasons given for the house prices cooling include stretched affordability, given the recent record run, and obviously the prospects of higher interest rates have taken the steam out of the market right now. But as I've been saying since February, in my February update, it's definitely becoming a story of more of a story of markets within markets. So let's take a quick wrap for me to illustrate this point. We saw Sydney prices off 1% for the month, Melbourne prices off 0.7%, Canberra prices off 0.1%. But that's not the entire property market, is it? On the other side of the coin, we saw continued growth, albeit at a slower pace in a lot of respects in some other markets. So we saw Brisbane for the month was up 0.8% in May. Adelaide is now our strongest capital market. It saw a very strong 1.8% price growth in the month. Perth was up 0.6%, Darwin up 0.5%, Hobart even managed to be up 0.3% for the month as well. And the combined regions were also up by 0.5%. So it just goes to show you, whilst the mainstream media will continue for the clickbait stories of potential price crashes, fixed rate cliffs, all the other hyperbole that we normally see out there, it's still very evident to me that there are definitely markets that are actually rising rather than falling. And some of those cycles are built on strong fundamentals of very, very low employment, rising wages in those particular marketplaces. And that bodes well for increased, price growth. Now, I'm not for a second saying that we won't necessarily see price growth continuing across Australia. That would be silly. It's almost impossible in the current point of this cycle where property prices will continue to grow right across the nation. But that said, we're definitely seeing several of those capital city markets and certainly some of those regional markets or commutable fringe regional cities to major employment centres are actually still, looking quite strong in terms of their price story. So it really is going to be a challenge around sentiment and confidence to see whether those markets will continue to keep rising during these times. In closing out this story around property values, I'd also add it's very clear in terms of my view in trying to own property in one or both of our two biggest cities. So even though prices are coming off in Sydney and Melbourne, good buying opportunities will present themselves in these markets in the year ahead, given where we currently sit. And if you've got a long-term view, then I'm definitely seeing some of the more smarter investors who want to own a property in either Sydney or Melbourne should be looking at those and keeping them on their wish list as well. So let's wrap up my June economic and RBA update. Let's just recap. There's no doubt that there is interesting times ahead for the economy. Generally speaking, hopefully the overall optimism on the back of record low unemployment, strong business conditions, record savings will see us successfully navigate the existing choppy waters of higher inflation and rising interest rates over the next 12 months. one thing I do know from my decades of living through these different cycles and these different economic times is that while some challenges are ahead and people see those as challenging times, others see opportunity to take advantage in such time. And for me, you know, for me, I'm one of those people who fall in that latter camp of seeing opportunities. The big question for you is, which camp do you subscribe to? So until next month, knowledge is empowering, but only if you act on it.